Is the great Australian dream of owning a property turning into a nightmare?
Real estate might cost an arm and a leg right now, but it could be a complete steal compared to what future generations might pay.
If property values continue to grow at the same average annual rate as they are over the past 30 years, house prices in Greater Sydney area could nearly double by the end of the decade.
The current median house price in Sydney is $900,000, and it's forecast that by 2030 it could be $1.7 million.
Housing affordability has been an issue in the Australian property market for a long time, and it doesn't look like going away. Home ownership rates among 25 to 44-year-olds has declined sharply since 1986 to 2016. And the Australian Housing and Urban Research Institute forecasts home ownership between 25 and 55-year-olds will decline to just 50% by 2040.
It's a complete joke. So in this video, we're gonna give you our opinion on how we can potentially fix this problem. We're gonna look at how we got here, and more importantly, we're gonna look at how we can get out of this, including when we think the property market is gonna slow down.
Before we start this video, if you find it helpful in any way, do me a little favor and hit the like button. Or leave a comment below for the YouTube algorithm. Just a little gesture like that can make a huge difference to the channel. And if you haven't already, consider subscribing below. So thanks you guys, it really means a lot to us, and let's dive right in.
So Jaden, how did we get here? And for those watching at home, please leave a comment and share your opinion on how we got here as well.
Well, if you're wondering why and how we got to a situation like we are in Australia where the property prices feel like they keep going up and up and up at crazy and crazy rates, there's basically 5 reasons how we got to this point.
The first is access to credit. Domain senior research analyst Nicola Powell says research shows interest rates are the key driver to the property cycle. Cheap interest rates means higher borrowing power, which effectively means people can borrow more.
And we've seen this firsthand. So from people that I spoke to 2 years ago when interest rates were around 2% higher to today have had a completely different picture when it comes to borrowing capacity. So I had an example of a single income earner. He was on $50,000 a year and his borrowing capacity went up from around $400,000 to over $500,000 over this 2-year period. That's a $100,000 increase in borrowing capacity. So what's just happened when it's been multiplied by not just this one guy, but the entire market, is it's pushed everyone's property values up by that amount. So when he could buy before for $400,000, now he's looking at $500,000, and it's the same. You know, people that were in the 800 looking at the $1 million bracket, the $1 million bracket, the $1.5 million. It's crazy. It's how it impacts what we've seen now. When people were saying before COVID, property prices were going to drop by 40%, they're now saying property prices have gone up 2%, almost 24% in the last 12 months. It's insane.
Yeah, we've definitely seen over the past 18 months, population growth is stalled, wages are stagnant, but house prices are smashing new records. Now you might think low interest rates makes housing more affordable since repayments are lower, but the people that really benefit from low rates are existing homeowners. As interest rates falls, their repayments get cheaper and the value of their property soars.
And this is where it sucks for everyone that's not in the market, because if you're still saving your deposit, you're getting less money because you're relying on the savings rate to try and increase your savings and how much deposit you've got. So it's had this impact where it's actually increasing the divide, which we're going to go through a bit later in the video. But the reality is it's made it harder rather than easy in a lot of cases, because things that you could pay and houses you could buy for $500,000-600,000 12 months ago are 20% more expensive.
The second reason why we got here is population growth. Over the long term, population growth has increased property prices. More people need places to live, and we're not building enough houses to keep up with that demand. Then prices will go up. Most of Australia's population growth comes from immigration. We haven't seen any immigration in the last 12 months due to the pandemic. But when borders eventually do open up again, this will start up again. Peter Tulip, chief economist at the Centre of Independent Studies, has studied this effect. He looked at the period from 2005 to 2018 when immigration accelerated from an annual intake of 120,000 to almost 190,000 a year.
It was insane. The impact of this was rents went up by over 9%. Higher rents meant properties became more attractive to investors, so it increased purchase prices. It was a vicious cycle. And the direct impact of this, having the borders closed, is that some of the rentals in the city have slowed down a bit in some of the major cities because there's been less immigration, and a lot of people, when they move in from overseas, go straight to Sydney and Melbourne. But it's also meant a lot of people are looking for more space. And so while there hasn't necessarily been that population growth, there's been a change in some of the drivers in what the types of houses people are looking for.
We also saw this with a lot of people moving interstate. A lot of people moving from Sydney and Melbourne, moving to Queensland, had a dramatic increase on the Queensland market. Number 3 is planning controls. There's always a lag when supply catches up to demand, and it takes time to build new houses. Planning controls can make that worse by preventing supply to meet that demand. In Australian cities, this happens by restricting high-density housing.
Yeah, in a lot of our cities, developers can't build crazy high-density houses in residential areas because there's restrictions. People don't have homes there, they don't have shadows coming over their backyard, they don't have people hanging laundry over lines. And so it actually causes prices to go up because you can't necessarily build more density in the city, so you go further out, and they've got to release more land, which just hasn't happened. Restricting the supply, and there's more demand because people want to buy it, so it's pushing prices up.
We see this in affluent neighbourhoods where they protest new high-rise developments from going ahead because it's going to ruin their suburb.
It's made it hard because it means they can't build more stuff in a city where there's already existing infrastructure. You've got to go further out, which means the commute's worse, and it's probably less appealing for a lot of people that want to live that inner city lifestyle.
Number 4 is tax policy. Australia's tax policies make property investment more attractive than other investments in nearly any other asset. Negative gearing means that investors can write off losses against their income, giving a tax benefit for owning a property.
And this became a really big political issue. In the last election, Labor was going to get rid of negative gearing, Liberals said they're going to keep it. There was a whole stouch over it saying that it was potentially going to crash the property market, it would mean cheaper prices, and it actually wasn't really true. Because data released from the Grattan Institute suggests that if negative gearing was abolished and capital gains tax discounts on properties were reduced from 50% to 25%, property prices would only be about 2% lower, which realistically is a bit of a drop in the ocean compared to how much they've gone up. They went up more than 2% last month in a couple of the cities. The other thing too in the latest property boom is it's been driven mostly by homeowners. In the previous booms, it was investor driven. People were speculating, they thought property was going to keep going up and up. They were buying on the hope that property prices would go up. In this boom, it's been people are buying a home because they want some space. They've been stuck at home, locked down during the pandemic. And so although taxes haven't necessarily driven this current property boom, it's short, it could potentially play a role in the future.
And the 5th reason is the pension. Now, the family home is not counted in the age pension assets test. Someone living in a house worth $300,000 is treated the same as someone living in a $3 million mansion. This encourages retirees to stay in their big homes or even upsize or renovate if they need to reduce their cash holdings. In an ideal world, the pension policy would not penalise people for downsizing. That would mean retirees could move into smaller homes, opening up the bigger homes for families that need them.
Yeah, it's a tricky one, Nate. I don't know if it's going to have a massive impact because most retirees stay in their homes for other reasons, and the reality is not all retirees have access to the pension. But I still think it does limit supply because there's a lot of homes in a city that might have one person living in them that could otherwise be sold and they'd downsize to something smaller and give more availability and more stock to home buyers that want to buy. So they're the 5 influences on why the property market has gone up and gone nuts, but what does it actually mean for you?
It's more than just having a home to live in. A recent released report called Housing, Taming the Elephant in the Economy outlines the effect of the housing crisis and the economy as abroad. There's productivity impacts, and the report found that higher housing costs actually reduces consumption of non-housing goods.
In other words, if people are spending more money on their mortgages or they're having to save up more and more for their deposit, they're taking that money from somewhere else because there's only a finite amount of money around. So it means that people aren't spending more money on the economy, they're not going out for lattes, not having lunches, which means people working in those cafes aren't getting jobs, and it slows everything down. So it's actually way worse for the economy as a whole. And that's not to mention that higher property prices actually push lower middle income earners further away from cities, which is mostly where the jobs are.
There is an instability impact. High household debt raise instability risks in our economy. Overall household debt has risen relative to GDP from 70% in 1990 to above 185% in 2020. 3/4 of this debt is in mortgages. And if you want to see an example of what happens when people have too much debt locked up in houses, you only need to look at America and what happened in the GFC.
And being locked out of the market also creates inequality. If you don't have the opportunity to buy a home, then you're stuck renting. And instead of building your own wealth and getting ahead, you're making a landlord rich. It just widens the gap further between the haves and the have-nots. And it gets even worse because it flows onto your children. Because for example, if your parents have their own home, you can get a guarantor home loan, which will let you get on the property ladder with no deposit. But if your parents don't own a home, then you have to go alone and you have to try and save up your deposit. And if property prices keep rising, then you're stuck on this treadmill of trying to get deposit faster while prices keep going up. It's just not fair.
So how do we fix this? Well, the government has got to step in.
Yeah, I think it's not just about the most recent stuff with home builder and trying to make more supply. It goes way deeper than that.
Here's what the guys from the report think we should do. The first is to set up a royal commission on the future of housing in Australia, to re-establish a cabinet to post responsibility for housing policies and housing outcomes.
And their last suggestion was actually to expand the scope of what the RBA does to maintaining a stable and well-functioning housing market rather than just looking at interest rates.
So when will the property market slow down?
It's going to depend on all of those 5 factors that we said before. So firstly, access to credit. If the banks start to slow down on lending, we've started to see some tweaks with their assessment rate. So that's working out how much you can borrow. And it looks like we've probably reached the ceiling of people's affordability. Like I said earlier in the video, there was a point where people's borrowing capacities had increased by over 100,000 and the banks have started to slow that down. So instead of that becoming 200,000, I'd say it's likely for that to reduce back to $80,000, maybe $50,000 as far as an increase relative to what it was a couple of years back.
Now we saw this over the Royal Commission, and even when APRA has stepped in the past with investment lending and trying to curve the lending down, which has a direct result on the market when they can get the lending down and restrictions in place.
Like I said before, population growth, if the borders remain closed for longer, it could slow things down because they're not having more people coming in. There's more suppliers. We're building a lot of homes because of home builder. So that could actually make things slow down, or it could make things go the opposite way, where if they increase the migration, like you said, Nathan, to 190,000 people a year, plus our natural population growth, it could push stuff the other way. It's a bit of a fine balance. And also interest rates. Or if there's an election looming, possibly tweaks to tax policy. If they potentially get rid of capital gains tax concessions for homes that you live in, which means people can't keep flipping and selling tax-free, or they change negative gearing. From the report, it says like that might not make a big impact, but it might make it more appealing for people to get in. If they say we're not going to get rid of negative gearing ever, it might mean more investors get back in the market and it could further push prices up because they've been sitting largely on the sidelines. So it's a lot of things that surely that the property prices cannot keep going up indefinitely. Which leads to questions, what can we actually do about it now? Any changes from the government, if it's planning, if it's tax, if it's retirement policy, are going to take years to go into effect. So what can we actually do about it? What can you do about it to get in your home sooner or to just get in the market? And the first one, Nathan, the First Home Super Saver Scheme.
Possibly the most tax-effective way to save for your home deposit.
Now the government's done some tweaks to this. Previously you could only go up to $30,000. They've increased it to a $50,000 concession. I think this is an awesome scheme. You need to ask your employer to specifically take more money from your payslip. So a common mistake I always get asked about is, can you just take it from your existing super fund? Can you just pull some money out of there and do it? And the answer is no. You've got your mandatory super contributions that come out of your payslip every week, month, fortnight, and that goes into your super fund. You cannot touch that. This First Home Super Saver needs to be saved on top of that. But you can use this to save your home deposit and potentially cut years off your saving. Check it out. We've got a whole other video on this that you can look at in the links below.
Now, or possibly you could look at rent vesting. Jaden, I know you're a big fan of this as well.
Yeah, it's a great technique where you don't need to be buying your forever home as your first home. You could potentially buy an investment property. You could look rurally, you could regionally, you could look in a different city. But it means you're going to get some property exposure, you're going to get into the market, and you can keep renting in inner city, Sydney, Melbourne, wherever you want to be, and still get in the market. So I think it's a really great technique, definitely worth checking out. Or ultimately, think about your other options. I think one thing that's been good with the pandemic is it's allowed a lot of people who otherwise couldn't have to work remotely. So although you might be based and living in a metro area, maybe you could look at going further out. We've seen a lot of tree and sea changes where people have moved to Noosa hinterlands, the Sunshine Coast, Gold Coast, even far west. So it's worth asking your work if that's something you can possibly do, because it could mean you could buy a bunch more property for a lot cheaper.
So that's it for today, guys. Thanks for watching. Hit us up with a thumbs up and remember to subscribe, and we'll see you next time.